we think is the current state of the market and how we expect it to flow over the next few months. So it's a kind of a crystal ball gazing based on how the markets have behaved in the past and some macroeconomic situation. Not that it will pan out exactly the same way. So, but first, some of the main headlines that we saw in September. So, uh, India is doing reasonably well. We are anywhere at about 6.5% kind of a growth that the economy is doing. So there is obviously some differences here and there between World Bank, Standard and Poor, but seems to be in a good place. Also, our trade deficit is reasonably lower, much lower. It has touched 80 billion, 100 billion in the past. We are now at a significantly lower trade deficit. Deficit continues to exist, but it's much, much lower. Our tax collections are very robust, which indicates that the economy is doing very well, and which is why people are, paying tax. Our uh, PMI, which is the manufacturing index, is also significantly positive. Um, the managers who are purchase managers index is what it's called. The purchase managers and factories give a certain survey, and which is what is counted. And their view over the next quarter, next half year is very, very positive. That's how it is. All in all, it seems to be in a reasonably good place from an economic standpoint. We are in a reasonably good economic thing vis-a-vis the rest of the world. Uh, some of the interesting slides on interest rates. Incidentally, this whole presentation was put together by a colleague of mine, Bhuvaneshwari, who's done tremendous work in gathering all this. We don't have a fundamental research team at Finsherpa, but we are able to gather research from all our partners and then share it here. So you'll also see the source of our partners here. So this slide talks about the global interest rates, how they have changed between the past and the present. While India has done plus 250 basis points growth, just look at how US has moved. US has moved 550 basis points. UK has moved 475. The European banks have moved 450 points. So all this tends to kind of indicate to you that there's a tremendous fight globally on inflation, and that fight isn't over yet by a big margin. That continues, and our view is that it will continue for another 9 months at least. 6 to 9 months at least will continue. Although yesterday the Reserve Bank governor didn't raise any interest rates, he did make a few comments to the point that if they don't see significant softening of interest rates, the next few quarters they may come back and kind of raise interest rates, is what he left unsaid. So interest rates globally are at a record high, which is the only way you can tackle inflation, and that's what's happening now globally. Uh, So equity market performance, global equity market, emerging equity market. If you take a 1 year view, it seems that there is some recovery that's happened in US. US, as you are aware, went through a dramatic downward curve during COVID, and then has been on a recovery, but much more slower than India. So India has kind of been a much faster, quicker recovery. So the last 1 year, uh, US, the S&P and Nasdaq have reasonably returned, but they're not out of the woods yet. Uh, India continues to do reasonably well. We are at about 9.5% growth rate at this point in time. So we expect that. We will continue our growth rate. Like I mentioned, we are growing at about 6.5% on the GDP front. So all that means that the stock market will keep in sync with that. So we expect growth to continue to kind of path well. The the sectoral performances, the theme, large cap versus mid cap versus small cap kind of performance, at least on a 1 year and a 3 year basis, indicates that mid and small caps have significantly outperformed large cap. Uh, the long term average is always, if you take a 10-year, 15-year, 20-year average of how these three indexes will perform, you will find that the small cap has rewarded the most, the mid cap the next, and large cap is the least rewarding within the equity buckets. So that's how historically we have seen this pan out. Having said that, the small cap has also been the most volatile. So if there is any concern that one comes across at an external environment, small cap index has been the fastest to fall and the most deepest to fall as well. So while it has been the one that's rewarded the best, it's also the one which has been the most volatile among all the three asset classes. So one needs to look at it. And the consensus that I'm hearing from fund managers is that mid cap and small cap in India are on the threshold of being appearing expensive. So they are talking about some moderation there, some correction is possible in the mid and small cap space going forward. So that's what I hear from fund managers. But nothing alarming or threatening. They just want to kind of, they believe that some amount of consolidation in these two segments of the market will actually be good in the long term. So, like I mentioned, just to support my earlier comment that small caps tend to outperform the large caps, small and mid caps, both ways. So, when the markets are falling, they will fall more. When the markets are in a good phase, they will also grow faster. So, that's how these indexes are. This is just a slide to kind of uh, you know, reinforce that view. India is a very difficult market to predict and play it from a trading perspective. So this slide is expected to indicate, between 2021 and June 2000, October 21 and June 2022, the index was somewhere around 17,005. Nifty index was 17,500 and 15,500 thereabouts. So a net change of about 10%. And FII is exited at that point in time, about 2,55,000 crores they took out of the market. And June 2022 to September 2023, the index has since bounced back from 15,500 or 700 to 19,630, right? So almost a 24% upside. And FIs have been able to bring back only 1,60,000, 1,70,000. So the point is, every time you exit the market, you'll find that your entry is at a slightly higher price. So that's why sometimes it becomes very risky in an emerging market like India to kind of exit fully. You, FIs obviously are also kind of investing in global markets, other markets, so they will need to rebalance, which is why they pull out of markets. But when you pull out entirely and you come back, you find that you're coming back at a much higher level to where you left. So that's the risk. That's the disadvantage of emerging markets at large. And today, what we are seeing in India is also the same thing. So why I'm mentioning this is many customers come back to us and say, shall we just, take all the money and move it out and come back when the market is corrected? It's difficult call to make. It's a very difficult call to make. So India, inflation is more or less uh, as global counterparts are. But in India, for us, inflation has always existed at a high rate. So inflation is a part and parcel of our life. So it's not really something that impacts us. In fact, the lack of inflation will really hurt India. Uh, of course, these rates are higher inflation, but a moderate inflation is something that Indian government itself wants. So to that extent, India is very comfortable with inflation. So the Nifty 50 EPS growth is something that everybody is now looking at. It is more or less at about 800. Over the next 2 years, is likely to go to 1100. So that's the span of growth that we expect to happen in the next 2 years. Why is this important? Because at the end of the day, markets are slaves to earnings, and EPS is earnings per share of the Nifty 50 companies. So if Nifty 50 companies continue to grow at about 30%, 25%, then stock market index cannot stay down. It will also go in tandem. There may be short periods of volatility, but in the medium and long term, they'll continue to do that. So that's what I'm trying to kind of allude through this slide. FIIs have come back. FIIs are really, really kind of bullish now on India. They are kind of bringing back money. Reasonably large amounts of money have come back in India. There was a period of big outflows. If you look at 2022, 17,000 crores was the outflows from FIIs. This year, almost the entire thing has come back into India. So to that extent, we are back in the radar of FIIs. The market cap to GDP is a very important, another important indicator that was made popular by Warren Buffett. So the market cap of just this is to indicate if the markets were expensive or cheap or reasonable. So that's the three measures that we try, and it's a rule of thumb kind of metric that is followed by Warren Buffett. His pointer is if the market cap to GDP is less than 75, which means if the market cap is less than 75% of GDP, then there is a real value in getting into the market. If market is 75 to 100 or 110, then market is rightly priced, and 100 or 110 and beyond, market starts being a little expensive. So as we speak now, we are at a market that's about 90 or thereabouts. So we are still in a good phase. There is not much of froth in the market, as they say. We're still in a good place for growth. In the future, markets, if the market continue to grow as we speak at this point in time, then you could find that they can become a little bit more expensive. But over the last 2 weeks, what we are seeing is markets are correcting a bit. They are taking in gains. There is a consolidation happening. So we don't think there is a big chance for a big, beyond 100 ratio on the market cap to GDP in the near term. I don't think that's going to happen in the near term. So we are in a good place from a stock market perspective. Return on equity from a Nifty 50 perspective is also reasonably good. It's about 15%, which is very, very good. The top 50 companies in Nifty are generating cash flows. There is a tremendous amount of push towards productivity-linked incentives, PLI. Tax has been cut. Government is very keen to set up a semiconductor fab facility in India. We've not done that so far. One of the ways in which Indian economy can move from where we are to where we want to be, we will have to kind of have some of these technology play happening. So government is engaging with a lot of partners to see if we can have our own semiconductor fabrication facility. These are very expensive. I was talking to an expert the other day. It seems like semiconductor fab, a good one, requires about $10 billion. So 10 billion in today's valuation of 85 US dollars works out to 85,000 US dollars. A lot of money. I don't think it's everybody's play, but India is very keen, and I'm sure we will find ways to kind of make it happen. Then in ease of doing business, we have moved up a couple of ranks. We are now a much more easier country to do business with. So a lot more foreign partners are looking India wise to see if they can set up business opportunities here. And of course, infra is a long-term opportunity. We have to kind of invest fully into our infrastructure. And the insolvency and bankruptcy code is likely to play a big role in cleaning up our uh, corporate system. We have a lot of corporates which were redundant through the IBC have been made favorable by selling it to another party who has kind of taken keen interest in developing that. And of course, the stakeholders of the earlier company have all been paid off. So to that extent, it provides a tremendous opportunity for people to participate in sick units and make sure that they can turn it around. And there's a big reward for turning around. So that's what this is. The government is doing its bit on a variety of measures, reforms. Um, this is just to indicate how consistent the economic activity is been and is likely to be over the next few quarters. So one of the questions I get often asked nowadays is election. This is going to be an election year. All of us know. Sometime in April to June, the great Indian election will happen. Lok Sabha election will happen, and in which we will go to polls to kind of select or elect our representatives and eventually our next prime minister. So in times like these, the general expectation is that there's likely to be a lot of volatility in the stock market. Yes, that is true. But evidence also suggests that these are also times when a lot of FIIs allocate a larger chunk of money into the markets. So it may not be a bad idea at this point in time for you to get in because eventually FIIs in a larger measure will also like to invest in Indian markets. So that way, there's likely to be a little bit of an upside in the election year. That's what we have historically looked at data, and that's what it seems to allude to us. Ever since GST came in 2017-18, there has been a formalization of the economy. Every month, there was a time during COVID when our GST collections were abysmally low. It was a very, very small number, growing significantly now. Post-COVID, we are hitting about 1.6 to 1.7 lakh crores of GST collections on a month-on-month basis. Now, assuming that the lowest GST rate is 5% and the highest is 28%, and if you take a weighted average of all, you would arrive at about 18%. Now, if you apply the 18% on this, that shows that on a certain sum, our monthly economy of GDP, monthly GDP numbers are a significant number at this point in time. So a lot of businesses which otherwise wouldn't have got represented within the GST are now represented because they are a formal organization. They give invoice for their supplies. They collect money in form of check or banking transactions. There's no more cash unplayed. So that way, the economic growth has also been kind of good thanks to all these things coming together. So incentives is driving India's manufacturing. Um, India can't replace China as the next largest market unless we significantly advance on the manufacturing front. There's only so much you can do in the services sector. We've done well, we will continue to do well in the services sector. But manufacturing is the big ticket item. And that's where I think we are going to see a lot more action. The government is focused at driving a lot more investors in that direction. So that investment, typically investment in manufacturing cannot be taken out suddenly. You cannot put a factory tomorrow and take it out day after tomorrow. Usually these are long-term projects, 10-year, 15-year, 20-year projects. So through that, you will realize a certain amount of potential from all these units that are being set up. And we expect that the China plus one strategy also will mean that there'll be a lot more interest in setting up manufacturing facilities by MNCs within India in the next 3 to 5 years. Big time manufacturing facilities are already being set up now, but I think it's just the beginning. We expect to see a lot more action coming in the next 3 years. So, how is India going to get to the $5 trillion economy, which is what has been the popular statement of the Prime Minister? In our opinion, these are the four pillars. Consumption is definitely a pillar. As household incomes go up, people are upgrading themselves, people are going out and eating a lot more, people are looking at a fine dining kind of a dining experience, people are looking at brands. They can go Domino's to Pizza Hut, things are benefiting out of this experience. But in the long term, this is likely to be even bigger. You will see a lot more people subscribing to a different way of lifestyle because their overall wealth has grown. Like I mentioned, infra is another space where I think the next 10, 15 years, India can put unlimited amount of money and still not be done with. After a very long time, almost 2006, 7, the, the capex cycle for corporates is just starting. So this year, we should expect a lot more applications for corporate wanting to set up their capital expenditure uh, workflow. And we expect that to be pretty significant as well. And of course, India is the jugaad capital of the world. Jugaad, I mean innovation. And I think we're doing reasonably well in that space as well. So these are the four pillars, as you call it, which are going to propel India to a $5 trillion economy. And we're not very far from that. India is also the best market for multi-baggers. Multi-baggers are stocks which give you a 5x, 8x, 10x kind of returns over a period of time. So some of these uh, economies have their own share, but India seems to be the one which is having a larger chunk, which essentially means there are a lot of young companies in India which are growing at a tremendous pace. And that's how you can have more companies in that space. So that's really the idea that I wanted to leave. So India continues to be a great market for equity investors. I'm going to switch this through. So the price to book value, which is another factor we look at, is about close to 3, which is not very expensive, which is in order. And the market is also trading at about 18 to 18 and a half levels on the respective index, BSE and NSE. And to that extent, I think we are in a reasonably good place now. There's nothing big to be worried. It's not like you have a lot of froth because of which you're overvalued, and it doesn't appear very cheap either. So I think it's a good place to be. Uh, I only hope we consolidate and grow from here to the next level. But is all well? Is there anything that we need to look out for? I think yes. We've had a period of the last 2 years when markets have largely been upward directional. We've had instances of a small correction at various points, but more or less the trajectory of growth has been upward. At this point in time, uh, the US markets is faced with a certain amount of global recession. Risk, at least there's a risk of recession, if not a recession. So I think that's one thing we need to be clear about. Interest rates and equities are not great bedfellows. So we expect that as interest rates continue to be high, equity markets will take some correction along the way. And earnings will also get affected if inflation is very, very high. And then supply side issues also continue, which is that there are no raw materials or raw materials are in short supply. All those things also impact the overall valuation. Now, what does all this mean for an average investor? Average investor, what we're saying is Please be prepared for a certain amount of volatility. How much is that volatility? Should it be 5%? Should it be 10%? No idea. But up to 10% of the market correcting from these levels, I don't think is a big thing. Given that we've had 2, 3 years of massive growth, a certain amount of correction is actually good for markets to consolidate, settle, and move up further. So that's where it is. I think there is also the higher crude prices. Crude almost breached $100 a barrel before it came down. So I think those are things. Crude um, is a big negative for India. India imports 100% of a crude requirement, and crude is definitely something that is bad. If crude crosses $110 a barrel, that will be a net negative for India, and we should see a fair bit of equity market correction happening at that point in time. It will impact our GDP, it will impact our growth numbers, it will impact everything else. So as long as crude is $100 and below, it's a good thing for India. Anything more than $110 is not a great thing for India. So that's one more counter we need to keep looking out for. I'm going to skip this. So one interesting development I think is important for us to know is that while India was always attracting equity money in the past, recently we read a report that JP Morgan has included India in the emerging market debt index. So going forward, we expect a significant flow of money to come into Indian debt market and thereby deepening the debt market. India's debt market is a good market, but it's not deep enough like the global players. So we need a deeper debt market, and this will probably be the first step towards making that happen, wherein JP Morgan is expecting a 10% allocation on in Indian debt over the long period of time in their global portfolio. So to that extent, we expect a significant flow, almost about 30, 35 crores or 40 crores of $40 billion is likely to come our way because of this change. But that's going to take a little while. It's not going to happen all at one go. It's going to happen on a month-on-month basis in a staggered manner. But I think it will come and it'll do us a very, very good when there's more access to funds in the debt market. So that's the other thing. So interest rates, long-term interest rates can continue to stay low if we are able to have a very strong debt market. So I'm kind of finally coming through. I'm going to sum up what is that we believe one should do. A well-diversified portfolio with a blend of growth stocks across large, mid, and small cap, especially in places like flexi cap and multi cap, with a long-term outlook, will be a good place to be. Given high valuations and macro concerns, one should look at booking some profit out of small and mid caps and move it into multi cap kind of a category. This is the great time for investors to rebalance their portfolio. What do I mean by that? If I have a 50-50 portfolio 3 years ago, I put 50 rupees in debt funds, I put 50 rupees in equity funds. Today, the debt fund after 3 years will be 65, but the equity of 50 will be almost 100. So if I need to rebalance it back to 50-50, it's a great time to do that. Investors who are now committing investments either must do it in tranches or must commit only to a balanced advantage fund and multi-asset fund, not to pure play equity funds. That's our thought process. Investors in debt funds with a reasonably large appetite for a risk can also look at long-term yields. Yesterday, long-term 10-year government securities reached 7.34. 7.34 is an unprecedented. Uh, there's a likelihood that you'll never see this rate ever in your life again. So The opportunities when 7.34 starts coming back towards 5%, which is the normal yield for a GSEC fund, that entire curve when the interest rates is moving down will lead to a massive capital appreciation for you if you're an investor. So that's the opportunity and that's the thing. But it has its risk because GSECs trade a lot up and down every day. So on a day-to-day basis, in the short term, you could still face a negative on account of GSEC investment. But our view is if you have a 5-year view and you're not bothered about short-term losses, GSEC may not be a bad place to invest in. So that's the point which from my end. Thank you so much and for being part of this on a Saturday morning. And I'm open to kind of answering a few questions.
Babu, may I start?
Yeah, please. Yeah, please.
Hey, thanks a lot for an excellent presentation as usual. What I wanted to ask you is on a micro level, that is looking at it from the investor point of view, and with the assumption that there are funds which do consistently well because their fund managers are good, and whether in good times or bad times, they continuously rebalance their portfolio so that they either, they time the market well or beat the market consistently over several years. And then, because, what the presentation that you made, I think at the micro level, at the investor level, this is too sophisticated for us to, let's say, decide on individual investment. So is it possible that you could identify such fund managers and such funds that have consistently beaten the market and therefore always a good long-term bet?
Yes and no, Ram, and I'll give you my thoughts on the question you raised. An excellent question. As always, very perceptible question from Ram. So there are no good fund managers, bad fund managers, Ram. Let me make that upfront. There are fund managers who go with a certain philosophy. The other fund managers go with a different philosophy. And I'll take this classic example. Right? There is a philosophy of investing which is called a growth philosophy of investing. And there is a philosophy of investing that is called a value philosophy of investing. Now, there are fund houses and fund managers who swear only by growth, typically. So, take the example of funds like Axis, for instance, or Mire to a large extent. All these fund houses and fund managers believe in the growth philosophy. Now, what is growth? The growth philosophy is I will buy companies and I will buy stocks which are growing the fastest at this point in time. I am willing to pay a slightly higher price, knowing that on a 3-year basis, their business would be double of where they are currently. So pricing really doesn't matter. So I will get the best deal going. Right? So that's the philosophy. That's the philosophy of growth. The opposite philosophy is what we call a value philosophy. I will not buy until it meets a certain buying criteria for me. It needs to be reasonable. It should not be expensive. It needs to be reasonable. Now, these are what is called a value philosophy. And every fund manager is either a core growth, core value, or a combination of growth and value. Most of them are a combination. Now, if you in a 10-year span of fund performance, you will find that there will be 6-7 years when growth will do exceptionally well if the economy is doing well. And there will be a 2 or 3-year period when growth will not do well and value will do exceptionally well. Now, if you ask me who is a better fund manager, there's no answer. Both are great fund managers. Only thing it's up to us to take the call as to where we want to kind of place our bets. So to that extent, I think that's one thought of mine that fund managers, uh, and just to kind of give you a background, last uh, 15, 18 months, growth philosophy as a concept has not worked at all in the Indian market. So the portfolios that are largely growth oriented stocks haven't really done that well. Whereas the stocks that are value oriented have done exceptionally well. So to that extent, you will see that even if the Nifty hasn't moved much or the Sensex hasn't moved much, within that you will have a kind of a mix. So to give you a quick answer is difficult, but I would say a mix of both the aspects is the best bet. And at Finsherpa, we have attempted to give you a good mix of growth-oriented fund managers and value-oriented fund managers in that. Specifically, I can discuss later on your portfolio, but this is the broad answer. Second is fund managers, uh, especially the mutual fund managers, stated view that I know of is to stay invested in the market. So if you give an equity fund manager money to invest in small cap funds, for example, and small cap is expensive at this point in time, he will still stay invested in small cap because that is the mandate that he has. He is not going to take 30% of this of that portfolio and keep it in cash or keep it in debt or something like that. He will not do. That is for investors to do or for us to do as investors. So this rebalancing is something that we will have to do. The fund manager will not do. Fund manager will do from one small cap, he can move to another small cap. But by and large, at least to the extent of 90% of the total assets, he will keep invested in the small cap space, irrespective of it appearing expensive. Does that answer your question, Ram?
Yeah, I think it does, and I see that you are playing that role, and yeah,
Exactly.
yeah,
Exactly. It's for the investors and for investment advisors to play that role of choosing to either stay or book profits or move around than the fund manager to do that.
yeah. Okay, thanks a lot. I appreciate, as usual, a very clear answer.
Sure. I've got a question from Mr. Ranganathan Rajagopal saying that what are the prospects of AI in stock market? Any insights? I think, like in any field, AI will play a very transformative role for every business. Many people choose to use AI with disruptive. I don't think I like to use it with disruptive. I believe transformative is a better word. Uh, uh, it just will make our life better. We will move to more a higher thinking job, more mundane work, or more work which we otherwise would have spent time on will move to AI. So I think it's a fantastic development. I think companies and industries which adopt AI into their daily play, we're already seeing that. So the other day, I was reaching out to a company on WhatsApp. I think it's a bank. I sent them a message. Immediately, I got a couple of choices that I had to choose. And through that choices, it led me to what I want to understand and finish off. And I don't think there was any human being on the other side. There's only a software tool that was working. So using AI, they've developed a tool that can answer simple queries instead of a human being available on the other side. So there's a lot of AI already at play. I think it just make life transformative for companies and industries in reaching out and doing. So I think I'm positive, but it's too early days to tell how it will kind of benefit stock market. I'm not able to make that judgment call. Murli has this question. Murli Krishnan has this question. What is the status of tech funds in the current market scenario? So good question. I'm personally very bullish on tech. Uh, um, Thank you, Ramdas. Thank you so much. So I am personally bullish on tech. Tech had a reasonable amount of corrections when the US market had its problems, because almost 80% of India's tech billing comes from US. So we had a correction. Since then, US has moved back significantly. So tech should do well, is my view. As economies become more and more smarter in using technology, AI, and all of it, I think the potential for technology companies to be an enabler in all this is going to be huge. So I am very, very positive on tech as a sector, especially in India, will continue to do reasonably well. Thank you, Mr. Ajay Gopal.
Thank
Happy
you, sir.
weekend.
Thank you.
Thank you.